We'll tell you.
Hi, good afternoon, everyone, or good morning, depending where you're listening from. This is Adam Rogers from DLA Piper, based in Miami, and I wanted to thank everyone for joining today's webinar on current and future investment trends in the urgent care merger and acquisition space. I think it's going to be we have a great panel today, Blayne Rush and Scott Witter, and before sort of turning the mic over to them, just want to give, just want to kind of touch base on where we are and where things stand in the urgent care M&A space. Obviously, it's been, a banner few years here, and it's ramped up very quickly, probably over the last 5 or 6 years, in terms of activity and interest, both from strategic players as well as financial sponsors and others in this space. 2014, saw probably more than 50 deals in urgent care close. Last year we had 2 mega deals, and some very large deals close with the acquisition by Optum Health of MedExpress for $1.5 billion, Optum Health being a division of United Healthcare, and then the sale of Concentra by Humana to a joint venture between Select Medical and Welsh Carlson for over $1 billion, $1.05 billion last year. And although the market's becoming more mature, it certainly still has a number of attention and focus, and there are a number of deals to be had, and we wanted to give you an update and some insight on some of the things that collectively the panelists are seeing. One of the questions that we wanted to start with, and we'll give this to Scott, who's the Director of Business Development for U.S. HealthWorks, is it seems like, at least as of 2015 and heading into this year, there's really sort of a frothy, fevered pitch, and multiples were creeping higher, and folks were the secret's sort of out on urgent care, and folks were really pressing to get deals closed and find deals. What are you seeing as we start 2016 in terms of sort of deal activity and what people seem to be focused on?
Got it. Thanks, Adam. I'll take just a quick 20 seconds to introduce myself first for the audience, and then get into that question. Adam said I'm the Director of Business Development at U.S. HealthWorks. I've been doing this for about 5 or 6 years. I manage our clinic acquisition efforts. One of the main growth strategies with U.S. HealthWorks is growth via acquisition. So over those last 5 or 6 years, we've completed 30 or so transactions, adding about 90 to 100 locations to U.S. HealthWorks. We've kind of taken the business from about 140 locations to I think we're up to 231 as of Monday, where we just made an acquisition and an entrance into a new state, Colorado. Most of our acquisitions are on the smaller scale. When I say that, I kind of think they average out around 3 or 4. We do a lot of single clinic acquisitions. We do make larger acquisitions. And one thing I'd like the audience to understand is position what we're coming from. U.S. HealthWorks is definitely an occupational medicine focused group. A lot like Concentra, I think urgent care is a large component of what we do, but we're certainly, if you look at the spectrum or a barbell, us and Concentra are kind of more on that occupational medicine heavy side of things. So when we're making urgent care acquisitions, we might be looking for things a little bit differently from some of the other urgent care acquirers out there. We like to see an occupational medicine component piece to the business that we can build off of. We definitely think the occupational medicine is really our expertise and the strength that we can bring to the table. Back to Adam's original question, kind of where we see things going through 2016 and beyond. I think Adam's right. I think we saw a little bit of a slowdown in late 2013 and early 2014. Picked up in late 2004 or mid 2014, where 2015 was, I think, very, very active. Obviously, we had a couple billion-dollar deals, another large deal with FastMed. I don't think we'll see too much like that in 2016, just because there's not as many of those opportunities out there. I think there is one large regional player that's on the market that we'll probably see an announcement or an acquisition, at least in the next couple of months. At least those are kind of the rumors we're hearing. I think we'll continue to see a lot of mid-size acquisitions out there, 10 to 30 locations. There are a number of those, I think, actively in market right now. Of course, what my day-to-day role is we're picking up a lot of single, 4 location and up acquisitions as well. So that'll be kind of, I think, the meat and the potatoes of what happens through 2016. But you might not see any too many major flagship acquisitions out there besides the one large regional that I think is going on out there. I think in terms of buyers out there, we keep hearing a lot about different healthcare service providers that aren't necessarily in the industry looking to move in. A couple years ago, we saw Fresenius, large dialysis provider, move into the market with an acquisition of MedSpring. Their main rival, DaVita, we've heard for a number of years, has been looking to get into urgent care. Nothing's really happened yet. I don't know if this is going to be the year that happens. I think you're really seeing a lot of push and aggressiveness by the health systems. I think they've been a little bit slow to come to the table over the years. I think they were around and looking, and there was a few acquisitions here or there. But if things had flipped over the years where, 2012, 13, 14 was really private equity driving the space, I think in 2016 and going forward for a couple of years, it's probably the health systems that are probably going to be the major players as buyers. And like I said, I think you're going to continue to see a lot of smaller scale acquisitions as a lot of the regional players find the right fits and the right locations and look at things as geographic fill-ins. We'll see a lot of that going on as well. Blayne?
Great. Thank you, Scott. Good. So Blayne, who is the president of Ambulatory Alliances and a investment banker who deals extensively in the urgent care and other physician ancillary spaces. Blayne, can you do you have any other thoughts there?
Well, I don't have a whole lot. I think Scott did a pretty good job of kind of, summarizing what's happening. The only things that I'd add, I do predict over the next 12, 14 months, as far as the vast number, so not the volume or the price volume, but I think the number of deals, I think we'll see the largest number of deals happen within the next 12, 14 months. And that's for a couple of reasons, is because these platforms have traded, and recently, a lot of them, and those guys are kind of settled out what direction they're going to go into. I know that some of the guys that had slowed down anticipating their actual exit are back in the game with cash, with aggressive acquisition focus. So I think a lot of those deals will happen. I agree that there may be one large transaction will happen this year, but all of those mid-sized platforms that Scott was referring to, all of them are on the market right now. And also about 2014, like Scott said, the health systems got into the acquisition mode more aggressively. Yes, they were in it a little bit, but 2014 was the hospital's year, and that hasn't slowed down at all since then. I think we'll continue to see that. There's a lot of those guys aggressively at the table for those smaller, when I say smaller, the smaller mid-sized type platforms. They're at the table trying to aggressively fight over those guys and the large platform that we were referring to before. So I think those guys are going to continue to be very active. We'll see different models with those guys, JVs, minority interests, etc. I think that that we're going to see a lot of activity here in the next year and a half. We're at good times right now.
Great, thank you. Yeah, so I think that's right, and I think the larger platforms, obviously, particularly when there's a financial sponsor involved, well enough can never be left alone, and there's always a need to keep keep that growth going. And it seems like there are still, it's still obviously a largely fragmented industry with a lot of, quote unquote mom and pops and 2 or 3 clinic locations up to maybe 8 or 10 clinic locations, with a few of the bigger platforms out there. From your perspective, there's so much attention, there's so much focus. We talked about financial sponsors and now the larger platforms, talked about health systems and even other sort of non-acute care health system providers getting in the space. With all that attention and focus, is it getting harder to find the good deals or sort of the diamonds in the rough? From my perspective, I know in working with some of the some folks in the industry, they're sort of widening their net in terms of being willing to accept a little more, some more hair on the deal, if you will, in terms of potential, compliance issues or, not as, because the low-hanging fruit's gone. What are you guys seeing? Are those opportunities still out there for buyers?
Yeah, I think that obviously the larger the platforms garner that are out there, they're going to garner the higher multiples, and people are very aggressive going after those deals. But like you said, even though the space is getting a little more sophisticated, relatively speaking, it's still a mom and pop industry where the owner-operators, or a lot of the owner-operators, really don't understand what they have. That's kind of why I have a job. The multiples from a buyer standpoint might be considered a little bit high compared to some of the other healthcare space, but many of the mom and pops have a great deal of inefficiencies, which obviously equates into higher multiples from the seller's perspective, because they can go in there and make it more efficient, run it a little smoother, grow it, etc., and make a lot of money. So some of the platforms are targeting secondary markets, or at least that's what we're seeing, because they see the opportunity for better deals. If a buyer can get there first, tie up the buyer, then obviously they have a better chance of paying less. And from a buyer standpoint, there's still deals out there to be had. It's just not as easy as it once was. The more educated sellers are holding out, and they're going to all of the buyers at the same point in time, which obviously drives up the valuation, and which I believe they should. Having said that, I think the arbitrage between the smaller sellers, what they'll get paid, and the value of the add-on to the larger platform is still in the buyer's favors. I tend to agree that a lot of the low-hanging fruit has been picked over the last few years, but I think that there still exists where opportunity exists where the owners or the original owners, they're not backed by private equity. They still operate somewhat as a mom and pop, but they're building or are in need of building a more sophisticated infrastructure. They have a great business, but don't have the bandwidth to grow. That's some places where we're seeing some of the private equity money's going. They're moving they're selling out of the top tier, moving down into the second tier. And these guys are typically 8 to 15 clinic businesses. A lot of times, like I said, they're in the secondary markets. I just spoke with a group this week that's in South Central California. They have 9 centers spread out amongst these smaller towns, run by 4 provider owners, and they have some very solid programs in place that have established relationships and kept those relationships, and their centers are doing some good things, and they're making a lot of money. And I think that can be replicated. So that's a good opportunity and a diamond in the rough. And there's others. I mean, say the people that have 5 centers in a market where there's no other multi-center owners, and the owner of those 5 centers, say, have been approached by the 2 local hospitals in that area, going through their process, and the hospital says, hey, I don't want to pay market value. That's too much. You know, and they give some lowball conceptually offer, and then a financial sponsor or one of the other consolidators come in and say, okay, we're going to offer you a lot more, then I think that's an opportunity as well, because the expectations are lower, because the process that the physicians or those owners just went through. And these are real life examples. And those are diamonds in the rough. A lot of times the secondary markets, some are tertiary markets, hold a great deal of potential for growth and gold mining. But I think the greatest opportunity exists, like we kind of alluded to a couple of times, is the 3 and under centers. You know, based off of my database, our research, probably 65% of the market consists of the owners that have 3 or less centers. Some of the buyers are being a little more flexible in what they're targeting, and I believe that others will need to follow if they're going to continue to show growth to their investors and find the opportunities. You know, many of the larger buyers have said, hey, we need 5 centers in order to enter a market. Some are now saying, hey, we'll buy 3 centers and commit resources to building or buying around those centers. So those are the things that we're seeing. And as far as the opportunities, there's still a lot of opportunity in the market.
Great, thank you. Scott, anything to add?
Sure. Yeah, you know, I agree with what Blayne is saying. You know, it is getting a little bit tougher. The obvious opportunities have been picked over a little bit. There's some valuation expectations that have creeped into some of the smaller operators as well. But still, there are a lot of opportunities out there. You know, when you look at a buyer, a strategic buyer like us, there's a lot we can bring to the table in terms of operational efficiencies. So it may be better payer relationships. It may be better buying power with vendors. Our revenue management team is phenomenal. So there could be great opportunities on the coding and billing and collection side. So it still means there's good opportunities out there, and they are, as Blayne said, going to kind of tend towards the smaller scale. Some of the larger mid-size operators, you know, there's a little bit less operational efficiencies that we can bring to the table, but a 2 or 3 clinic grouping of clinics, bringing them into our systems and procedures and whatnot, there could be some substantial growth that we can bring to the table. So it is going to happen. There are opportunities out there. It's going to continue. I do agree that they become smaller and smaller, but I also do not think that there is a tremendous amount of consolidators out there, or at least consolidators out there that are looking in the same geographies. So you have some of the large regional companies out there, but they might only be looking in a handful of states, and the next group is looking in a completely different group of states. So I don't necessarily think you're seeing a lot of competition as well for some of the smaller opportunities. There might be a handful of you know, regional buyers out there, or you might have to look at your local health systems, and I think that's where you're going to see some of the better opportunities. Adam?
Got it. Got it. So before we sort of start looking at a few different perspectives or segments of urgent care transactions, just wanted to kind of talk a little bit about sort of the seller's perspective in all this. So if you are those, you know, 3 to 8 to, you know, or 8 to 12 center operators, is, you know, we've seen some pretty heavy multiples, and Scott, I know you just said, you know, even at the smaller operational end, you know, with a fewer number of facilities, that sort of valuation expectation has been creeping up. You know, if you're a seller, is this time to get out while it's hot, or, you know, is it better to stick with your strategy and, you know, continue your growth and do what you do until you're actually ready to sell?
You know,
or Scott, that's fine.
I'll jump in. I think that's a tough call, because, you know, in my mind, the smaller opportunities trade at a fraction of a multiple of the opportunities with size. And on the flip side, you're in a stage where the valuation multiples are quite high. They're historically high. So you have to ask yourself, how long are they going to stay at this particular pace? Are they trending down? Has it plateaued? We have a little bit of a perfect storm in terms of valuation. You have historically low interest rates. You have very high demand in the market. You have a lack of supply of good opportunities out there. All of that, could change. Certainly there's a tremendous amount of growth in urgent care. So you're seeing the 3-4 clinic chains grow to 6, 7, 8. You're seeing the 10 clinic chains grow to 15 to 20. So that supply could change. There's obviously still heightened buyer demand and still heightened valuation multiples. But you have to question how long that lasts. The flip side of that is I think there's tremendous multiple expansion as you get up there in size. The larger regional players are trading at extremely aggressive multiples, where the smaller 1, 3, 5, 8 clinic chains, as I said, trade at a fraction of that. So it's a bit of a trade-off in terms of trying to time. If you're a growth company and you're going to get more clinics into the system and things are laid out and there's a tangible opportunity, it might behoove you to keep going down that growth path. If you're thinking about retirement, you have 4 clinics, and not planning to grow, not planning to build anything else in the next couple years, maybe now is the right time. But I'll pass that over to Blayne, because he may have a different opinion.
Yeah, I get this question asked often, right? I mean, I have phone rings on this question, 10 times a week. Some of the challenges that it's becoming tougher for smaller operators to be successful. That's for a few reasons. I mean, like was mentioned before, urgent care is a proven model. It works, and there's a lot there, and therefore competition is growing. The business of medicine is becoming more complex. It's not just, hey, I have a practice. You have a business. And billing, collecting, hiring, EMR, shortage of physicians, that type of stuff. And consumers are demanding a hell of a lot more than they did, 10 years ago. And you have to have a true business in order to be very successful and to continue to have solid margins, to be able to squeeze out some of those inefficiencies. And that puts a lot of stress on the owner-operator, the physicians and the operators that still using their stethoscopes and their families. A lot of those, again, are mom-and-pop business. So you have to either need to be expanding or joining someone that is. And I'd point out that you don't want to wait to the peak of the market, because you need to remember that the buyers buy future profits, not historical profits. That's your money, not their money. In order for you to maximize your valuation, the buyer needs to know that there's still growth in the market. So you want to kind of sell prior to the peak. But there's 4 things when people ask, whenever they say, hey, when do I know that the best time to sell is? So I suggest 4 things. What do you want, and where are you currently? What is do you have a lot of gas in your tank? Do you still have risk tolerance? So Scott talks about continue to grow. Do you have the tolerance for the risk, and do you have the capacity to grow? Do you have the team that can go out there and say, okay, here's the locations that best work. Hey, I have to go. It takes money, so equity or debt, so you have to use your own money, or you have to go get some debt or some partners. Do you have the tolerance for that? And how much longer and how hard are you willing to work to build that? So that goes to, hey, am I willing to grow or not? And do I want my life back? Because a lot of the owner-operators of these 3, 4, 5, 6 centers have kind of tapped out on their ability, and they're kind of tired and say, hey, I don't have the gas in the tank to double this in size. And then you talk about, where's your business in its life cycle? So you have your startup, your initial growth, rapid growth, slowing growth, plateau, and decline. conceptually, that's the difference. And the markets kind of mimic that. Where is your business in that growth cycle? If you're at the slowing growth, can you expand and then reposition it to the rapid growth phase conceptually? So if you think of, hey, I want to expand, so now we're going faster again. Are you able to do that, and are you willing to do that? Then where's the market in its life cycle? Because whenever we have the best time to maximize your exit is whenever we have the most buyers entering the marketplace. Okay, and I think we're close to that. I think we'll be there within the next 14, 15 months and say, okay, that's the time that we want to exit because there's more competition. Okay, and obviously competition drives up the prices because they're, it's just supply and demand. And then where are the financial markets? Scott talked about the debt's been cheap and easy lately, and those larger companies are able to leverage a hell of a lot more debt to turn around and buy your company for debt. So on their side of the equation, it looks like they're paying a heck of a lot less because they're using low interest debt to buy your business. And so whenever debt's cheap and easy is whenever they're able to pay more. No different than mortgages, to put it in simpler terms. Whenever anyone with a heartbeat can get a cheap mortgage, then your housing prices go up. So those are kind of the things that you look at. It's kind of a science, but also you got to kind of figure out where do I want to be, what do I have the stomach for. This time right now is very good. No doubt, and I think we'll talk about this later, is where the price breaks. Is it at 5 centers because we talked about, hey, everybody wants 5 centers? I think that is one, and where do you go from there? And is it worth the risk and the tolerance, and do you have the stomach for that? That's kind of a process that you have to go through, and there's people out there to help you go through that.
Yeah, agreed. And I think you bring up a great point, which is between the debt and cost of capital, being so relatively cheap, if what is that cutoff where a large player, even a regional player, someone trying to get in the market says, you have 2 centers, 3 centers, between our transaction costs and integration costs and all that stuff, we'd be better off just setting up new shops in the area, and we think that you don't have a strong enough market hold to thwart that, and we can be successful starting out. Are you seeing, either of you seeing more of the established companies sort of turn to more of a de novo play or startup rather than when they enter into a new market or otherwise, rather than trying to pick up some of these onesies and twosies?
I guess I'll start off. We're in a hyper-fragmented market where the opportunities are great, but there's no just one successful roadmap for all the players. Scott alluded to this about saying that most of these, there's no true national buyer. There's not really anyone that's really close to that. We've said this over and over again, but many operators are looking for opportunity, be it buying 3 to 5 center clusters in a market, then building de novos, or buying the one-offs in that market and taking some of their existing centers, creating JVs with hospitals, doing the same with new centers. For some of the smaller platforms, all of the buyer types are chasing those deals, meaning those mid-levels. So the hospital systems, the larger consolidators, the private equity guys, they're all chasing those deals, right? And those are few and far in between that they're, build a de novo or acquisition or whatnot can't be their only growth strategy. I believe for many, if not most, it is more of all the above type strategy based on geography and marketplace opportunities versus where can I execute this narrow strategy. So I think that whenever you look at a single center, and we'll take one for example, and these are just generalized numbers, average numbers. So people will say, hey, it takes anywhere from 500 to $1.5 million as far as the burn rate and all that type of stuff to build a center, get it up profitable, and get it on its way. Well, a lot of these one center type transactions, they're averaging $250,000 to $500,000 in EBITDA. You can buy those things if it's $250 for $1.5 million, you know, and then you can go on and do the rest of the math for the other size numbers. So there's a lot less risk. So I don't think that that these platforms are saying, hey, this is the only route that I'm going to go. I think most of them are, because they're sometimes landlocked as far as the geography goes, unless, again, they buy a cluster of centers in a new marketplace, that they're going to look at the existing marketplace that they have and execute on any of those strategies that we just kind of mentioned that make sense within that marketplace.
Yeah. You know, my perspective, Adam, is it's you almost see de novos first and then M&A, because, you know, I think there's a little bit of a wildness and a unpredictability within the M&A strategy. You can't necessarily pick where you want to go. You need obviously a willing buyer, which would be ourselves, and then you have to have a willing seller on the opposite side of things. So a de novo strategy is I think much more under your control. You can pick where you want to go, when, in what capacity. You can set up the clinics how you want them, what works for your system. When you're doing M&A, you're you know, kind of getting what you can, and it might not be necessarily the right fits, the right providers, the right cultures. So I think kind of M&A is more of a secondary strategy, especially when, as Blayne mentioned, kind of landlocked. So if you're a regional provider in you know 2 or 3 states, let's just say you're in California, Arizona, Nevada, you're not going to be looking at M&A in Florida or New York or whatnot. So you know you've really cut down where your M&A opportunities might particularly be. You know, say somebody even like us, you know, might be a city that we're trying to get into, but there's no willing sellers there. There hasn't been for a number of years. Might make more sense to kind of enter with de novos. I do agree. You know, probably most groups have a little bit of a blended strategy. You look at acquisitions and then layer de novos around it. I think that's a very solid strategy. You know, I think you also see a tendency towards M&A out of the more mature businesses. M&A for you know is not easy to do. There's a certain level of expertise you need internally as well as externally to get through an M&A process. It's not a simple process. And also, I think the more mature companies start looking at de novos as a drag. When I say more mature companies that might be coming up for a liquidity event, private equity group own, they're 5 or 7 years in, they're about to be sold, they're looking more for immediate EBITDA contribution to the bottom line. So they might turn off the de novo strategy because that has a lot longer return on your investment. They end up being a negative drag on EBITDA for the first, whatever, 6 months, 12 months, 18 months. So they might want immediate bang for their buck, and they might see that in M&A. You know, a regional business, as we talked about, you know, the multiple expansions that are out there. Let's just say a large regional player is able to purchase up businesses at 5 or 6 times EBITDA, but they know when they're sold, they're going to be sold for 12 or 13 times EBITDA. That's, you know, an immediate, you know, doubling of EBITDA in an arbitrage sense. So you'll see that strategy going on quite often as well. Adam?
Sure. In terms of stepping away from sort of the more traditional M&A, you know, we've seen a lot of health system interest and a lot of payer interest in urgent care, you know, in terms of both strategic alignments that may be short of true acquisitions or true, you know, true mergers, let's say, you know, more of a, like Blayne alluded to before, minority investment, joint venture, you know, or other types of affiliations. Where do you see those types of arrangements going? I mean, what is, you know, hospitals are obviously, and health systems are getting into urgent care in a big way. You know, is it more about, you know, sort of getting a better foothold on the gateway sort of patients, so to speak, in the community, or is it about truly about revenue generation and sort of integrating another service line?
So from my viewpoint, there's a couple of reasons that these health systems want to get in there, and one is obviously access to the patients, right? So they want to go in there and create an entry point into their network and then keep those patients within their network. But also as they move towards the more capitalization or capitation type model, and they're responsible for these healthy lives and these accountable care organizations and all the derivatives along those lines, is they want a place to be a low-cost provider treatment for their patients that are easy access, et cetera, because all patients are demanding and becoming more consumerism and more focused on the retail type medicine, and so these hospital systems see that they need to bring these clinics and those types of services out to the people versus, hey, here's our ER, which is a heck of a lot more expensive, and it's miserable to go into an ER and wait, or at least traditional ER, and have all that wait. So I think a lot of it's driven by the cash flow, the patient, bringing them in the network, and then actually saving money by treating their patients in a low-cost provider location. I think that what you're seeing here is, say, the for-profit health systems. They're the ones that are more so aggressively pursuing these larger platforms. HCA is on a tear, right? Tenet, those guys are those types of hospital systems are being very aggressive, versus some of these nonprofits. You're seeing some of these models that are popping up that private equity is investing a lot of money into, like the Go Health, Premier's out of New Orleans, and some of those guys that are doing these joint venture arrangements. They're buying some in those, but a lot of times they're de novo strategies, and I think that's a lot to do with the different philosophies between the nonprofit hospitals and the for-profit hospitals. So I think those are the two routes that those types are going. So the bigger guys that are for-profit, they're buying the platforms and buying some of the regional players, and even some of the local guys. And the nonprofits, the larger ones, again, are having these strategic relationships that are creating these joint ventures and whatnot, and building all around their center. But they're also on the local level, they're buying some practices as well. At least that's what we're seeing.
Great. Go ahead, Scott. Anything to add?
Yeah, I probably don't have much to add. I think Blayne's bang on, but you're definitely seeing a lot more joint ventures out in the market now. Obviously, I think we talked about it before, that it taken the health systems a little bit of time. Some of them I think got it early, and some of them it took a little bit more time for them to figure it out. But there's a huge cost containment opportunity here. There's revenue opportunities here. I think health systems have been involved in urgent care for a while, but they've never really been great operators of urgent care. This is really a different bag here, and I think a lot of what they're looking for with some of these operators is somebody bringing to the table some expertise in consumer-driven retail medicine that the hospital doesn't necessarily have. There's great opportunities for referral streams towards the hospitals. I think they clearly understand that, whether it's ortho, whether it's surgeries, physical therapy, advanced imaging, specialty referrals. A lot of this can be fed into the health system. So obviously there's a revenue play. It's also keeping the patient within the system. There's branding at play. It's getting more touch points out into the community, getting the hospital system's name out there. It's a feeder into their primary care network. A lot of these patients going into urgent care don't have primary care providers, and they can be directed and moved towards the health system's primary care network. I've heard it can be as simple as lowering their cost of benefits. The hospital systems have tremendously high benefit costs, and joint venturing in with a hospital and moving the urgent care out to outside management company gets those employees out onto the private companies' benefit plans, lowering the cost for the health system. So there is a lot of different angles and avenues being played here by the health systems. Adam.
Yep. No, I think that's a great point. And then another sort of not necessarily late entrant, but probably not as frequent an entrant as the health system are the payors. So we've seen, obviously Humana originally bought Concentra in 2010, sold it last year, but as it was selling, United's provider arm, effectively Optum, acquired acquired MedExpress for $1.5 billion. We've also seen a number of transactions in the industry where payers have taken minority stakes or otherwise, joint ventured with the existing operators. How are you seeing those transactions unfold, and are they, what do you think is sort of the driving force for the payers?
Scott, you want to start? Or?
You go ahead, Blayne.
Yeah. So, obviously you talked about the Concentra deal. It's my belief, based off of the information and having conversations with some of those folks, is that they were looking to go heavy into the primary care and some of the acute care type settings, and obviously that was a large OCMED play. And whenever I guess the recession kind of hit, they kind of moved over and started focus on wanting to grow in the urgent care market. I think the concept was very good, was strong, but I think the marriage was just off, in the sense that maybe if they would have bought a NextCare or one of these other more urgent care players, it probably would have been a better fit and would have lasted or would have worked. I do believe that the long-term play as far as the urgent care market is that we'll see the dominant players, or at least they will be some of the dominant players, be the people that have the most vested interest in the space. And I think the provider and the payer kind of line is going to become more and more blurred. It's already getting a little bit blurred in some markets. There's some hospital network providers that are now jumping into the insurance market, and some of these insurance companies are jumping into the provider market, and those are the systems that have the most vested interest in the in healthcare. So those are going to be the ultimate players where everybody exit. At least there'll be a lot of different models, but I think those will be major players within the system, and that's driven a lot by some of the mandates out of the Affordable Care Act, where they say that these health system or these insurance companies have to spend, I think it's 80% on care. So their profitability, their 20% comes in overhead, profitability, administrative, executives, all that type of stuff. So they're going to have to expand where they get that 20% and lower their costs, et cetera, to continue to grow, because if they're able to lower their premiums, they're able to sign up more people, and it's just simple economics. But I do think that long term that the payers will be major players compared to some of the models that they used before, where they were a state Blue Cross, one of the state blues, investing in one of the urgent care platforms that are in that state, and they're taking a 10-15% interest in that company. I don't know that that's the right model going forward, and I don't know that we're going to see a whole lot of that going forward. But I do believe that the national and the larger guys are going to be dominant players within the space.
Yeah, I'll just have a little bit to add. I do think more payers will look to affiliate with urgent care networks. I think you have to kind of put the Humana Concentra transaction aside in its own box. I think Humana didn't really find what it was looking for with Concentra. They're trying to make Concentra something that it wasn't, trying to make an Ocmed business into a urgent care, primary care business. Not a simple feat. I think it was just not the best fit between two different parties. The United Optum kind of seems like a very different animal, and that one's going to be very very interesting to watch. Their acquisition of MedExpress. I don't think MedExpress was necessarily for sale at the time. I think United, who's often kind of looked at as the smartest or the smarter guys in the room, kind of said this is where we want to go after, and didn't really take no for an answer. So they have a very I think defined strategy with what they're trying to do with MedExpress, and I think some of the other large payers are going to be looking at that. So I do think that's going to be very interesting to watch and to see how it unfolds. I do think it's going to be a major influence on the industry.
Yeah, agreed. And with all the changes that you've alluded to with affordable care, and in terms of one, requiring cost efficiencies, shifting from pure fee for service to value-based purchasing, focus more on quality outcomes and provable evidence-based medicine. I do think that the payer investment in providers has been significant in all segments of the industry, and I think that urgent care is a particularly interesting play for those payers that sort of have that appetite, particularly around the managing their patient population and their spend. One thing that as we only have a few minutes before we pause to take some questions here. Looking into your crystal ball, and I think, Blayne, you alluded to this, but what is the next phase in the life cycle of urgent care? Is it are we at a point where sort of the valuations and have started to undermine the investment thesis of financial sponsors, where you can't get that I'll take a 6 multiple and turn it into a 12 arbitrage that Scott mentioned? Is the ultimate sort of future here going to be health systems and payers taking some of the big boys off the market, or where do you see things going? Are we going to wind up with a CVS and a Walgreens of urgent care? I know they're both in the retail clinics, but are we going to wind up with instead of a few large regional players, are we going to wind up with 1 or 2 national urgent care players?
So I think we're going to end up with a few models. I think that we'll have some CVS type Walmart guys that say, hey, they're a dominant player within a market. No different than we see the CVS Walgreens model, in the sense that, hey, they'll have some that are open 9 to 9, whatever it is. I don't know what time they're open, but then you'll have some 24-hour urgent cares that those other guys will funnel to. But I do believe the largest players are going to be the payers and the health system providers, for all kinds of reasons, and that we've alluded to. I think that as far as the private equity guys, what I anticipate and what we're seeing is that, so they're going to build these up, and we've seen it with all other types of industries, so they're going to build them up, sell them to the largest strategic guys, because, if you look at the large platform that we alluded to earlier, in some of these larger platforms that have come to the market, the people that have been able to pay the most is the ones that have the most invested in the system, meaning the healthcare system, because they're able to gain value by all of the synergies, by putting these two companies together, by downline revenue, entry into their network, all of that type of stuff. So the healthcare systems and the payers are able to outbid the financial buyers. So what the financial buyers will do, we'll see those guys stepping down to the tier 2, if you will, type platforms, and build those guys up and bring those up to the tier 1, and here we go again, right? So I think that we still have a long runway within urgent care space. I think we'll see urgent care change. I I mean, you see Zoom Health. If everybody go research Zoom Health out there on the West Coast, those guys are expanding the definition of urgent care. There's some other people doing that as well, maybe on a less sophisticated, more local level. But those guys are saying, hey, what about ortho urgent care? And what I mean by that is you get Uber ortho, meaning that you go in there and need to see an ortho that day, you get to see them. GI, peds, same thing. So they're moving, and they're a lot more complex than that, but I'm keeping it along the urgent care space. So I think we'll see different models come out. I think we'll see acute care, and it's exciting, and we got a lot of time left in this space.
Yeah, I think Blayne's right. I think there's still a long way to go. I think it's still a pretty unconsolidated industry. There's still a lot of growth too. There's new urgent cares opening up all over the place. So it's definitely a non-mature market. We touched a little bit on private equity. There's still a role for private equity, and they're still going to be very heavily involved. There's always going to be the entrepreneur who has 5 or 7 or 15 clinics, and he doesn't want to sell out. He wants to grow, and he needs capital. He needs an investment. He needs other people's money to help really light a fire on his expansion plans. You're also going to see private equity kind of passing amongst themselves, as we've already seen. That's going to continue to happen. But we touched on it. The multiples can get a little bit high and really kind of stretch the financial metrics that private equity groups are looking for. So you might kind of see them dip down. For the first time, I saw a private equity group a couple months ago buy a 3-clinic chain. That's not normally where private equity groups are involved in. It's too small. They need a little bit more bulk there, a little bit more history, a little bit more substance, a little bit more profitability to lever up on. But maybe there's a role for them to take the 3 to 5 clinic chain, to take that into kind of a regional or a citywide chain or something along those lines. I think it's uncertain if the industry is going to be dominated by the health systems or the payers yet. There's still an opportunity for a couple of these regionals to come together and create a public company. I don't think we're there yet. You need some significant more growth there to I think support a public company, but that could happen down the road. But I think one thing's for sure, you're going to see kind of continuous consolidation, continuous growth, probably over that next 5 years, pretty continuously.
Great, thank you both. I think at this point we have a few minutes left. Why don't we turn it over to questions, if there are any?
Yeah, so there was a question that came through talking about, hey, if urgent care strategies is going to include post-acute discharge services. I don't know what the larger companies, I could see like the USPIs, they're a ambulatory surgery center, national company, one of the strongest players within that space. That Adam and I for sure have a lot of experience in that space and a lot of understanding. So they've brought on, they were bought, or a big portion was bought by Tenet, and Tenet moved their urgent care platform under USPI, and then they turned around and bought a big chunk of CareSpot, or what was left over CareSpot centers from when they fluffed off, I don't know, it was 15 California centers or something along those lines. And so now they have a sizable platform. Well, I know that I've worked with a company on a buy side that we've looked at some of these strategies where, hey, they get discharged from ambulatory surgery center, and if there's any issues, they'll go to the urgent care for post-acute follow-up, pain, etc. So you can conceivably see that happening. I don't know of anyone that's executing that strategy today, but I would think that there's enough smart people out there that we can't be the only ones that have kind of thought of that. I just haven't been exposed to it. And so we could see that, you know, even down the road when urgent care is open for 24 hours, they might have an infusion center. Someone comes in for a total knee joint that's been that replacement that's being carried out in an outpatient ambulatory surgery center, and some reason they have a lot of pain, they can go to this urgent care that's networked with them and get that taken care of and seen. So I think that's a great strategy, and I would anticipate that's going to happen somewhere down the road, if not already.
Yeah, and just to add on to that, Blayne, we work with a number of doctors that have, sort of been at the more or less, towards the front edge of, working towards bundled payments and, taking risk and things like that. And we've seen orthopods who, can now, basically do a hip procedure in a way that can be done in an ASC. And it's, they probably have to, most of them probably have to trim a little bit of their time off to get to get within the 24-hour rule. But in any event, for those types of providers and that type of surgery, as you see sort of more complicated procedures moving to outpatient departments, ASCs, and the like, I think that's right. I think there's definitely going to be a role, to the extent the patient's going to wind up being not ready for discharge, but under Medicare rules or otherwise can't stay, so as not to jeopardize that. You may see some arrangements where, hey, you're in urgent care, you have providers there who could supervise and sort of watch and make sure the patient's okay. I'm making enough money on my bundled payment where we could afford to shift some of that to cover some of the post-acute care, and in terms of it being out there now, I mean, we have seen scenarios like it, not post-acute care specifically, but where, for specialty pharma, like you mentioned, infusion centers or pharmaceutical manufacturers, potentially, certain medications, specialty medications, when you take your first dose or two, you have to be medically supervised. And so, we have seen companies approach clients that are urgent care centers for that type of monitoring and sort of ancillary services to what you would think of as traditional OCMED or urgent care type services, just kind of monitoring services.
So we've got another question. What do you mean by primary, secondary, and tertiary markets? I can answer that, but if any of the other two want to go.
No, that was your terms, Blayne, all you.
Yeah. So primary market is, so I'll give you some examples versus a definition. So primary market is Dallas, okay, Dallas-Fort Worth. That's where I am. So here's a very populated market that they're set up all over the place, right? So secondary market might be considered like Tyler, Texas, which is 60,000 people, where there's some opportunity. And then a tertiary market is a much smaller town outside of that, Paris, Texas, if you will, where they might have one or two urgent cares that would be able to flourish there. Those are the, primary, secondary, and tertiary markets examples. So here's a question, Scott. I'll put you on the spot. Yeah. So we talked about that the smaller seller operators have valuation issues where they want more than it's worth. What are the thresholds of the multiples right now? Why is there an upper limit for profitability price to the buyer? So essentially the way I understand this question is, why does the smaller owner operators able to sell at a smaller multiples versus as you get larger, why are they able to demand larger multiples?
Right, okay. More is better is probably the easiest way to answer it. So more EBITDA goes for a higher premium. So people, private equity groups, buyers, whatnot, it's much easier. Let's say there's 10 million in EBITDA on the table. It's much easier to get that in one transaction than across 10 different transactions. Much more effort across those 10 transactions. All the internal costs the effort of the buyers' transition teams, the outside attorneys involved, the outside accountants involved. So that's probably the easiest, simplest way to kind of say that. There's going to be more demand. There's more buyers. There's legions of private equity guys who they don't look at something under 50 million EBITDA or 10 million EBITDA or whatever the hurdle is. It's kind of what's in their fund parameters. What they've kind of gone out to the limited partners and said what they're going to do. There's a whole angle of the capital markets and lending off of this in terms of the size of the businesses and the amount of profitability there. So there's a lot of different factors that go into it, but it can just be boiled down to more is better. I don't know if you want to add to that point.
Yeah. I'll add a couple of things. So part of it is that for it to be we talked about true business, and I'm not saying that the smaller guys aren't a true business, because you are, but whenever I throw out the word true business, we talk about, hey, they're able to stack this overhead and these, corporate CFOs, these corporate CEOs, development team, et cetera, to grow the business. So there has to be enough size to the business where they can squeeze out what they need to squeeze out and still make their internal rate of return, because they have a rate that says, hey, we have to make a certain amount on our money and our investment, and we have to be able to grow at a certain amount. So that's part of it. The other is, Scott said this, but let me just expand on it, is the capital market. So the larger a business, the less risk with that business. I mean, if you have one urgent care, 3 urgent cares, and there's a higher risk associated with that business, meaning that it could go under. One of these buyers tells me all the time they're one flu season away from losing money. So they look at it that way, and then the cost of capital. So you have debt and equity. Equity is just considered cash. Okay, debt is obviously, there's many ways, there are many buckets of debt, if you will, but essentially that's money that you have to pay back, and it's debt. So debt is cheaper than equity. The larger that your business is, the less risk there is spread across, and the more debt you're able to leverage. Banks will loan money to a $150 million business when they would never do that to a $10 million business, or they not at the same terms. And the same thing with these health systems that we talked about. These health systems, the reason that they're able to be very aggressive on their valuations, especially for the platforms, is they're able to be able to leverage debt at a very, very, very low rate. And so if you have a 2% 2% mortgage, or a 2% on your debt that you have to pay back, versus the 12%, 7-8%, whenever you get to huge zeros, multiple hundreds of millions of dollars, that's a lot of difference in the money. So those are a lot of the different reasons, and obviously competition that was already mentioned. Let's see if there's any more questions. I'm trying to look through. This box is real small. Yeah, so I don't know. Let me scroll down. Yeah, I think that's all the questions, so you can go ahead and wrap up.
All right. Great. Thank you, everyone, for attending, for the questions. Scott and Blayne, really appreciate it. I think this was a great discussion. Thanks, everyone, and have a good afternoon. Good weekend.
Thanks.
Thank you.
Thanks.